What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. If you're joining us here on YouTube for the live stream, please click the like button and never miss a live stream by clicking the subscribe button right here on YouTube. This podcast is sponsored by EdgeClear. EdgeClear was designed by traders for traders. They are a forward-thinking broker earning a reputation for unbeatable service. When you join EdgeClear, you'll be assigned a personal broker who will get you set up, assess your needs and costs, and will hopefully help you save. Today's guest is the founder of EdgeClear and my good friend, Morad Askar. Many of you know him as Futures Trader 71. Today, we are going to discuss the how-tos of trading sustainably. This is the first show of our partnership, and throughout the course of the next 12 months, over 12 monthly live streams Morad and I will be doing with some guests along the way as well. We're giving away over $10,000 of prizes. Plus, we have a promo just for you traders tuning into the show today. EdgeClear is offering you 69-cent commission for most products and 20-cent commission for micro indices. Go to edgeclear.com/deli and click on open an account at the top of the page and sign up with the code DELIEDGE. We want to hear from you throughout the discussion, so be sure to drop your questions or comments in the YouTube chat. There's my friend, Futures Trader 71. Morad, what's up, buddy?
Thanks for having me on.
Great to be here with you today. You know, I'm excited about what we're doing here over the next 12 months. You and I are going to be live every month. We're going to have some guests. We're going to be going into a lot of discussions about a lot of important things. I mean, that's the one thing people always say when you and I get together, we get right into it. And we're going to get right into it today here in just a moment. But I do want to talk about what we're doing, giving away prizes and just getting traders engaged and just having some fun with this too.
Yeah, that's a big part of it. I mean, not only are they going to be drinking out of a fire hose throughout the next 12 months with these sessions, we're going to try to cram in as much about trading sustainably, professionally, upping your game this year as possible. And we're generous enough to give you prizes while we're doing it. So it'll be fun.
Yeah, totally. It's going to be fun. And we're going to have all sorts of different prizes throughout the year. So you guys got to just stay tuned and see what we're going to be giving away each and every month and see some of the really cool guests and important topics we're going to be discussing. Today, Morad, this topic to me is, I'm glad we're starting off with this. It's obviously a very important. How does a trader sustain success? How does a trader grow? We're going to talk about a whole bunch of stuff. We're going to talk about how to use CME Micro contracts properly, a bunch of things. We've got a slide here in front of us right now. So those of you that are tuning in later on audio, you can go to YouTube or anthonycrudele.com to check this out. And a lot of people have been asking, since you are watching this on the live stream, this will be recorded and put on all of my audio and video platforms following this. So Morad, let's kick it off. Things you should know by FT71.
So the objective here of this particular session is to help traders set some real expectations on how to trade sustainably. We hear a lot about those statistics, 90% of traders fail, and I dispute those. But in general, those failures are caused by a poor or an uninformed approach. And our series here is really about getting traders to think in the form that is sustainable, right? If you're not here tomorrow to trade, if you've blown up your account today, that's not very sustainable, and you're done, you're gone until you refund and start over. There are many traders also on these funding services who keep trying and trying and trying. And whether you're doing that, whether you're doing this with someone else's money or your money, there are really some really key things that have to be done. Now, I want to express that derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. And I also want to really impress upon you that if you skip these steps, you might have success, but I would call it luck. You really need to get down and start by deciding, I have to decide on my commitment level. I have to decide on whether I'm trading because I want to get out of my job, leave my job. So am I going into trading because I want to replace my income and have the freedom to be able to trade and kind of be my own boss? Um, am I doing this as a hobby or an interest? In which case, you're kind of replacing a trip to Vegas with a trip to the market, kind of. And so losing money may not be as painful for you. Are you doing this part time? Are you transitioning? Or are you doing this for a quick buck, which doesn't work? And so decide on your level of commitment. That establishes the foundation and the baseline for how our approach is going to be. If you're doing this because you want to supplement your income, or you work a night shift and you want to trade during the day or part of the day, or you want to replace your paycheck with some revenue out of the market, the first step is to decide that that's what you're doing and to make that commitment. The next step, and this is the boring stuff, is to write a plan. You got to sit down and almost act like you're funding yourself and you're requesting those funds as if you're borrowing the money from a bank or someone else. You need to treat it that way. So you need to sit down and just establish, what are you doing? How much are you going to put into it? When will you trade? How are you going to trade? What's your time frame? What products are you going to trade? All of that needs to be written down. And the reason we're going to write things down throughout this process is because it's something that you and I have experienced, you having blown up early on as you got started, me having basically run my accounts down to about $8,000 with a new baby and really deciding I'm either going to do this or I'm not. And that's when it helped me make the turn to have that kind of pressure. We have to decide what this process is, and we have to keep coming back to that plan. We're gonna go astray through this process quite a bit. It's gonna happen again and again and again. I've backed a lot of traders. I deal with a lot of traders, and I can tell you that nobody's immune to this. So that's the next thing, is just write it out, and then this is a living document. You're going to keep coming back to it. Once you know what you're going to do, in other words, if I'm going to swing trade, like Deli here swing trades some products, day trades others. If I'm going to swing trade, it basically means that I need more capital. I'm going to have wider stops. Therefore, I cannot risk, I can't risk 10 or 15 or 20% on every trade. So if I'm swing trading, I'm going to need more money. If I'm day trading, I'm going to need a little bit less money. If I'm scalping, I'm going to need even less money, that sort of stuff. So once we have a plan and we know what our approach is, and this isn't perfect, once we know what that is, we will then start to work on capitalizing an account. And my recommendation to you is to always start to fund and start with a micro product. So even though you might want to trade the NASDAQ, just plan on trading the micro NASDAQ and fund for the micro NASDAQ. And the recommended amount of funding, the capitalization portion, is really important, because at EdgeClear, I hear the team here constantly talking to customers who want the minimum amount of margin, day trading margin possible. And the recommendation is to fund with full margin at a minimum per contract. So go to the CME website, find out what the initial margin is and how many contracts you're going to trade, do the multiplication. That really should be your minimum funding, as if you're going to hold a position overnight, even though you're day trading. Okay? So those are the first few steps. Do you want to kind of, for me to keep going through these, Deli, or what do you think?
Just going to go. I'm going to comment on just those quickly on those three things. Sure. First, deciding on the commitment level. I look at my experience and pretty much everyone else I know. You go in with these expectations that you're going to make money right away. So your commitment level is based upon how you do, right? I mean, if you're going in as a trader. I mean, I was on the floor. I figured there's no way I'm not going to be making money right away. I mean, initially that's my thought, right? And it took me 3 years before I actually started making money. And all of a sudden I'm working jobs and doing other things. And your commitment level is test after that. I think it's easy to say that you're going to come in fully committed, and until that Mike Tyson thing is talked about where you get punched in the mouth, it's hard to know. So I think that those other two things really play into it, and it's so important is that you can't really come in with a lot of expectations, because it'll challenge your commitment level right out of the gates. I mean, my expectations were I'm going to make money. All of a sudden I'm not. How committed am I? So I was challenged at that point. Write your plan too. I also want to say my plan has changed so much over the period of time that over especially the beginning part of time where you don't know really who you are. So when he talked about capitalizing your account properly and aim for the micros, and people trying to get the lowest amount of margin, to me that already sets you up for an unsuccessful journey before you even get going, because you're already going to be challenged, I think, by too many things in order to, I think, really give yourself a good chance at it. I, even at this day, I almost never use leverage now. I mean, there's every once in a while I'll go beyond I what I would consider, full margin to be able to put a trade on, because my thought process is, if I need that margin, I only should need that margin in very rare times. Very rare times. Do I need that? Majority of the time, I should be using less than full margin, because there's not enough good trade setups for you to be able to use all of that. And I think that so many people going in thinking that they're going to use the margin as a way to get up there quicker. And actually, I think majority of the time, the exact opposite happens, and it trickles down to all these other things you talked about.
Yeah, those are good points. I mean, coming in and looking for $80 margins on a micro ES or something like that, it just, I mean, no offense to anybody, but it's funny when somebody says no offense to anybody, they're about to say
I'm
something
about to offend them.
offensive.
Yeah, exactly.
No, but it's just kind of a dumb way to start, because what that says is that, statistically speaking, and remember, this is all about probabilities and statistics. We're playing a game of statistics. This is like poker or blackjack or any of those games. We're really betting on probabilities, and if you're coming in and you're placing heavy bets from the get-go, the risk of ruin is extremely elevated, and you're not likely to last. So cut it out with the margins. Really, 50% intraday margins, 50% is about as much as you're going to need. If you have good expectancy and you have good returns and you want to lever up, you might go to 25% of initial margin rather than funding. But in my opinion, when somebody's asking for more leverage than 50%, which is about $600 or something like that per contract on the micros, to me, that's just someone who's likely to have some issues. So capitalize properly. Once the account capital drops below that 50%, so the initial margin on micro ES is like 1260 or something like that. Maybe one of my brokers here can pop in and tell me what it is. I think it's $1,200. Deposit $1,200 per contract, so put in $2,500 to be able to trade two. Once the account value drops below 50%, it's time to refund or retool or do something, or find a lower margin product like the RTY or the micro RTY, something like that. So funding is one of the historical pain points of trading futures because of the leverage, but with the advent of micro products, this isn't a problem anymore for most people.
I just want to say one quick thing. You're already in a leverage product. It's already, people look at it and trying to get more out of the margins. I mean, I get it. Not everybody has the money, but you don't need that much. You're already trading something that is leveraged. So just think about that.
Yeah, you're already getting, I believe you're already getting 10 to 1 on notional value in leverage at the exchange. And when your broker goes and offers you $80 margins, $100 margins, they're multiplying that by 10, which is great for the broker because then you're more active,
Exactly.
you're busy, you're generating commissions. But in terms of trading professionally or sustainably, lower margins are not a selling point. I know people push it, but lower margins are not a selling point. So once we've capitalized the account, do not trade. I know there's going to be an urgency to go and click in the market and see, make $1. Don't do it. Just sort out your hang-ups, figure out your errors. I track errors religiously. Execution errors are the thing that's going to eat your lunch. Execution errors are things like FOMO, over managing a trade. You wait for your set, you do your homework, you wait for the setup, you get into a trade, and then you take a tick and you scratch the balance. Like that's an error. Putting on a trade, and then Deli gets on Twitter and says, you're long the Ultra Bond, and Deli gets on Twitter and is like, the Ultra Bonds are overbought, man. I'm selling the crap out of them, and then you close your trade. That's an error because that's not your plan. Hitting the buy button when you meant to sell, buying too many, selling too many. These are the kinds of things you need to track, and they happen because our brain is flustered at the beginning when we're trading. Violating your risk is the ultimate and cardinal sin. It has made a lot of people move from trading large accounts to going and getting a job, and it's a sad thing to watch, but these errors are the thing that you're working against. So you're not focused on P&L. I'm not talking about P&L here. We're focusing on process. So look at your hang-ups, look at your headspace. Why is it that you can see what the market was doing after the fact, but during the trade, it's all just jumbled up. Like these are emotional, psychological issues. I would highly recommend someone like Jared Tendler, Tendler's book, who we'll have on in a couple months. I highly recommend that process of mapping your mind, your process, those sorts of things. Work that out on your paper trading account. Do not move to live until you have a positive expectancy in your paper trading account. The next thing is managing expectations. Another thing I'm going to tell you from, I started backing people in 2003. Something that inevitably happens is you get these cool guys with the cool hair like Deli coming in and wanting to trade, right? And, they've been successful elsewhere. They've duked it out. They've kind of grinded through. And you tell them, there's a part of you don't know until you start trading, right? And they're like, I've been an athlete. I've been awesome. And it's true. You're going to learn a lot about yourself when you trade. There's nothing that teaches you the reality of who you are like trading. And you want to do this at the lowest cost possible. So the way to manage that is to manage your expectations. You're going to fall. You're going to make mistakes. You're going to make mistakes that you're making but can't stop yourself from making. All these things are going to happen and are just part of the process. So don't get discouraged. It is really important, and this is easier said than done. It's very important to just focus on the process. So we don't want winning trades that are done outside of our execution plan or outside of our plan. Those are mistakes. Those are errors. We want trades that lose money within our parameters, within our plan. We definitely want trades that win within our plan. But the winning and the losing, and I want to emphasize this, the winning and the losing is not up to you. It's not up to you. This is up to the market. It is random. It's a random distribution of outcomes. And it's not up to you to do more homework and use more indicators to get only winners. It's never going to happen. So the only thing you can control is the amount of risk you're putting in to find out, the cost of that token you have to put in the slot machine before you pull the lever on the next trade. That's your stop. That's your risk. And it's up to the random generator that is the market to be able to pay you or not pay you. So our goal to get there in the long run is to simply follow our process. Because our process through our paper trading, which is point number 4 above, our process has an edge and it makes money over time. And so you need to be here over time in order to exploit that edge. That edge isn't going to show up if you take 3 trades and blow up your account and now you're done. It's going to show up over hundreds, if not thousands of trades. Like Deli said, it took 3 years to really get it sorted out. That's a lot, given that he was in the pit, every day, right?
Everybody's making money but me, you feel like that. And I know a lot of you could feel that way too. And I see some comments coming out where people talk about, the percentage of traders that are failing. And I always say that I have no way of knowing what percentage of traders fail. But what I do know from my experience and why I have failed early in my career and why I've seen a lot of traders and I've talked to thousands over my career and why they fail. And this is the number one reason that I see is managing the expectations. I don't think that the vast majority of traders fail because they can't do it. I think it's because they aren't making as much as they thought they would be or wanted to be. Because most traders come in and say, well, if I'm going to do this and commit to this, I want to be making X amount. So it's not that they couldn't make money. This kind of ties in with the leverage and all that. It's just they couldn't make as much as they wanted. And I get that, but that doesn't mean they failed. It means that in a lot of the ways you set yourself up for failure, thinking that you were going to put 10 or 20 grand in and make 500,000. That's just not reality in these types of markets. Some people definitely will always break through and be able to achieve that, but very few.
Well, we want to be in the middle, right? We don't want to be Michael Jordan, and we don't want to be somebody who just fails early on. The sustainable trading, this is about the how-tos of trading sustainably, is being in the middle. And being in the middle means you can have a 40% win rate, a historical win rate, and still make money. The goal here is to expect to grind. You're gonna grind. There's gonna be a lot of grinding. And there are times when the grind gets you in the zone, and then you can push if you have the equity or the account size. You can push during those periods. And when those periods come to an end because volatility is falling or volatility is expanding, depending on your approach, then you're starting to pull back. But the grind is what gets us the results. And the grind is boring and it's not paying the bills, and it requires a lot of discipline and kind of self-motivation, but that's what it takes. It's really important to just focus on the fact that you need to show up and you need to just follow your process. It's like swinging a golf club. You can't come in and just like hack at it because you think you can get the head of the golf club to hit the ball. There is a process of setting up, putting your feet a certain distance apart, tightening certain muscles, relaxing others, pulling the club back and going through with your swing, keeping your arms a certain way. And the only way you can get professional and do that sustainably, kind of like Deli does, because it seems like he golfs like 3 times a week.
You can't get this tan without golfing 3 days a week.
I know. It's the tan, the hair, the muscles. I can't take it. So you need to just swing that club. You got to be on the driving range, and you need to just practice swinging the club. And people who are on the driving range aren't aiming to hit the flag down the field. They're focusing on how the swing feels. They're focusing on the process. Trading is the same. You want to do that in a paper trading account, work it out, and then when you bring the expectation that you should have is when you go from trading your trading account, your paper account, to your live, your goal is to kind of stay in that mindset, because now the market is actually very punishing in terms of getting your fills, the psychology that comes with trading live and having money on the line, even if it's a micro product. You want those things. You want those to be the things you're dealing with at the point you go live, not how to swing the club. Like, the process for that should have been handled and worked out in paper trading, In live trading, it's about psychology and risk management, bar none. That's it. So it's key to come in with the proper expectations. The next thing I have is keep shedding noise. So the process for every trader is they come in, they find a broker, that broker's edge clear. They come in, they find a broker, and then they open an account, and then they go and they read 16 books, and they watch 6 different guys trading on YouTube, and they watch, they buy a seminar, and this is a process of accumulating knowledge. This is the second stage of competence. You accumulate a whole bunch of knowledge, and what happens is over time, you start to realize that knowledge is actually getting in the way. And your process, and bullet point number 6 here, your process becomes about forgetting this stuff. So first, it's kind of like when we eat. You eat a whole bunch of food, and then your body goes through the process of distilling what it needs and throwing the rest out. That's step number 6. You want to get rid of all distractions while you're trading, at least for the focus time of your trading, like the open or the first 2 hours of the open, something like that. That's what it is for me. Then you want to get into the process of shedding information. You want to have as little information on the screen to make a consistent decision as possible. So you want to make the decision so easy, and the more stuff that you bring in, the tougher it gets. And so if there's a line on your chart, like look up at your charts if you're at your trading station. If there's a line on that chart that is not part of the decision process, not part of setting your bias, not part of triggering a trade, click on it, delete it. It is adding to the noise. So this is step number 6. This is when you start to move from being a hobbyist to being a professional. You start to cut down on everything that is not contributing to your edge. Okay, that's what this is. What are your thoughts on that?
For me, it's like I just need to know the direction that I want to be in, and I need a couple of indicators tops, right? I think a lot of people have redundancy in their indicators. They're using multiple momentum indicators, which is basically almost the same thing, right? They're not going to give you too much variation, just too much redundancy when I look at a lot of these people's charts, versus just finding 1 or 2 indicators that are different, and one maybe more for of a directional or momentum, simple as a moving average or anchored VWAP, something like that, to just help guide you. I think that too much just causes too much confusion. I really, as a trader, and I know a lot of you guys out there, more you as well, you just think about it. When you come into the day, I'm really probably only looking for one side of the market. For me, on a personal level, I'm almost never trading 2 sides of the market anymore intraday. I know scalpers, they may trade both sides quite frequently, but I think that if you could focus in on one side and just having a set of indicators that give you what the higher probability direction would be for the day, it really does simplify things and help you become a better executor of your strategy.
Yeah, I agree with that. I mean, there are many different ways to skin a cat, but the point of this really boils down to, you want to get to where Deli is, like you want to get down to the point where you're just needing 1 or 2. I say if you have more than about 5 items on your screen, it's probably not helping you. And an item is not just a single line. An item may be the initial bounce, which has a high and a low, or reference lines like where did we open, things like that. But if you have 6 moving averages, a CCR, an RSI, and a MACD, and then you layer on top of that some sort of trend line, man, where do you decide? By the way, the point of execution is the point where there cannot be any hesitation. You hesitate, the trade is gone. So adding more information simply provides reason for you to actually think. And you don't want to think when you're executing. Executing is not about thinking. You don't have a golfer swinging the club and going, okay, now I need to straighten my arm. Okay, I need to follow. No, they're not doing that. That happened in practice. That's gone. You want to just swing. And wherever the ball ends up, you'll deal with it. But you want to just swing. And so having complications on the screen are likely to contribute to that noise. Okay? We're 30 minutes in.
Oh yeah, it's,
Should
you
we
know what
keep
that
going?
means. No, you know what? Good eyes. You know what that means, everybody. Well, a lot of you participated in this. I'm so excited at this. Next, we will be spinning the wheel to see who the winners are. Morad, tell everybody what we're going to be spinning the wheel for here in just a moment.
So today we are going to pick 3 winners, and we're going to pick 3 runners up. And the reason we pick 3 runners up is because the contest has rules. If you want to refresh yourself on the rules, go to edgeclear.com/deli, and there's a portion there that tells you what the rules are. So we pick 3 additional people in case someone becomes unresponsive or they don't qualify for whatever reason. They don't meet the rules. So we're going to pick 3 winners, 3 runners up, and we're going to send you off a Bose Quiet Comfort noise canceling wireless headset, which is phenomenal, by the way. A phenomenal product. We're giving away 3 of those. We'll ship them to you if we can. If we cannot, we will provide you with the value of the prize, a financial value of the prize instead of the actual product, in case we can't ship it to you. Okay?
Okay. All right, everybody, quick break. We're going to spin the wheel.
Streamline your trading setup with Edge Clear, the forward-thinking broker for active traders. From our unbeatable service with an assigned broker to Edge Pro X, our robust and reliable trading platform, Edge Clear offers more than transparent fees and fair prices. Designed by traders for traders, we combine the best of technology, service, and risk control. Our dedicated brokers are here to help you grow. Join Edge Clear today and elevate your trading business.
All right, let's take a look at this wheel here, Morad. Boom. Okay. Before we spin, I want to go over a couple of things, everybody. Earlier in the show, we mentioned that our sponsor for this is Edge Clear, and we're going to be giving away over 10,000 worth of prizes over the next 12 live streams. Now, in the spirit of helping traders connect, Edge Clear is going to give away 5 Logitech 4K Pro webcams in the next drawing, not this one, but that will be next week's. In each month, or next month, I should say, in each month, you have to sign up for that. Our next show is going to be on April 27th. We'll give you details of who our guests are going to be and what we'll be discussing. And to sign up for that giveaway, you have to go to edgeclear.com/deli before April 27th. And I also want to remind everybody about a promo that Edge Clear is running for everybody that's watching today. I mentioned this also at the beginning of the show. If you join Edge Clear with the code Deli Edge, going to edgeclear.com/deli and sign up with Deli Edge, you get 69-cent commissions for most products and 20-cent commissions for the micro indices. We got the page up here right now showing you where you go and do that. Now, Morad went over all of the rules, and all the rules were on that page for it. So now we just spin this wheel. Look how many people signed up and how many.
Yeah, okay.
And how I can't even see all the names on there, but I know the name will pop up when we see the winner.
It'll pop up. So I want to tell you that this is a third-party picker wheel. We have no influence on this wheel. All duplicates have been removed, whether you use a duplicate email, duplicate IP, or whatever. Those guys were removed because it's unfair to everybody else. We got a whole lot more participants than we had planned to. We thought maybe we'll get 100 or so. I think we're topping 500.
500, yeah.
And so what I'm going to do is spin the wheel and then note down the name. And we're going to spin this 6 times. The first 3 are winners. The next 3 are runners up. So the 4th person would be the priority person to replace one of the winners if we cannot get the prize to them. And the 5th one replaces the second winner, and so on and so forth. So we're doing this 6 times. Every time we spin, we're going to remove the name of the winner so that the probabilities increase for everybody else. So here we go. There it spins. So the alias is Cap'n Kevo. So
Cap'n Kevo. Cap 1, man.
So we're going to hide Captain Kevo, and we're going to spin again. Charlie.
Well, there could be multiple Charlies. We'll see which Charlie.
The aliases are unique, so we can't have the same alias used twice. So Charlie had to have put in Charlie, but we'll know who that is. We have your email and stuff. So hide.
Let's see who the last winner is going to be. Rambo 007. He's got a
wow, that's lethal. It's a muscular guy with a martini. All right, so here are the runners up.
Popeye.
All right.
These names I crack up at this stuff. A happy.
Yeah. So each one of you will get notified. This is the last person right here.
The last runner up. M. Bernold.
M. Bernold.
Okay, cool.
All right, very cool. That's
nice, guys.
Yeah, that
congrats to the winners. All right, we'll get back to talking about trading stuff.
Very cool. So we're the next thing you need to really focus on as part of this training sustainably is process. Okay, so we are focused on process. Period. I discussed this a little bit, so I won't regurgitate. But the goal here is that you want to go into a process-based mindset, not an outcome-based mindset. You do not want to focus on your P&L. Just accept that whatever money you've set aside for risk is money that you're likely to lose, and you're likely to lose it, and that's just tuition. And thankfully with the micro products from the CME, it doesn't have to be that much money. So we want to focus on a process and make it second nature, kind of like learning to walk or relearning how to walk after injury, through physical therapy. You want to get to the point where you're not thinking about every step, you're just getting up and doing it. So your goal is to come in every day with a relatively clearly defined plan and just follow your process. Follow your process. And this, by the way, requires a whole lot of trades and a lot of time. So be ready for that. The next thing is, it is all about execution and risk factors. So two things that have to come together. In fact, we dedicated a year, Deli and I, a couple of years ago, about execution. I mean, all the shows that we did were about execution. At the end of the day, you can be the greatest analyst, you can call the top and bottom every day, but unless you're trading, unless you're executing and managing, it doesn't mean anything. And the biggest thing that influences outcomes over a series of trades, not just one trade. One trade, the outcome is always random, 50-50. You win, lose, we don't know what's going to happen. But over a series of trades, we want to realize an edge. And I can tell you that statistically speaking, and you can prove this through a randomizer, the most important thing to account for as part of our execution is risk factors. A risk factor is simply the amount you are going to get in return for the amount of risk that you're risking. So if I'm risking 10 ticks and I'm going for 10 ticks on a one lot, my risk factor is 10 ticks gain divided by 10 tick loss gives you the result of 1. That is a 1 risk factor. So you're risking 1 unit per unit of gain. On a 1-to-1 risk factor or less, in fact about 1.2 or less, regardless of the product, it could be lumber, orange juice, cattle, lean hogs, cocoa, it doesn't matter. It could be bonds. If it's less than 1.2 or so on a randomizer, the equity curve tends to move down, tends to be negative. So one of the biggest things you can do to improve your edge right now, and this is the most actionable thing I'm going to tell you today in today's session, is improve your risk factor. And the way you do that is you size your trades or change your analysis or your expectations or the way you trade so that you're getting a multiple of your risk. So if my stop is 10 ticks, I need to be going for 15, 20 ticks, preferably 30 ticks. 30 ticks on 10 ticks of risk is a 3R trade or a 3 risk factor. This is the quickest way or the best way to improve the overall equity curve. It doesn't make you immune to an equity curve that starts and moves down, as you might be fighting the bias or the trend or whatever. But over time, given that every time you win, you get 3 times the amount that you lose, over time, your equity curve is expected to be positive. It's expected to slant upwards. So if you want to talk about the holy grail of trading, this would be it. It's mathematical. What you have to do is do the math and look at how you're looking at trading and make it so that your trades don't get less than 1.5 to 2R per trade, period. And what that also means is that your risk has to be reasonable and you have to stick to it. So you have to hold your stop, and you have to be well funded, and you have to let your trades get to the wins. You can't say, oh, I trade a 10R plan, meaning for every tick I risk, I'm making 10 ticks, but then you never let it get to 10 ticks because, that's basically a momentum-based strategy if it's getting that big an R factor. This is what where the difference is. Get your R factor up. It's the biggest adjustment you can make to your execution, to your plan, in order to trade sustainably. What are your thoughts on that, Dilly?
For me, this is why the micros have been the greatest addition to the futures markets in my lifetime. Obviously, I was around when they introduced the E-mini, which gave me an opportunity as a floor trader who stunk to trade electronically. But the micros are great because if there's anything I've learned about execution, for me in my trading, is that you need to be able to have flexibility in price. You can't be stuck to one single price, and you need to be able to adjust your execution based upon the distance of the risk. And when you have a smaller contract size, you are allowed, with the micros, you're allowed to have some flexibility around your execution in and around your execution out, basically scaling. Because I know that this is so difficult for all of you to do. I struggle with this myself. I don't care who you are. It's hard. Talking about what Morad's talking about is if I buy in at the S&P, or if it goes exactly to my price stops and I don't get filled and it pops up, do I have the ability to step in and buy a tick or two above? Can I do that and be able to add multiple contracts in? Also, if it gets near my resistance level, if I'm long to sell, do I have to sell it exactly at the tick? Can I sell a tick below, or can I try to have a trailer to sell at target 1 and then potentially target 2? To me, that's where the real skill of execution and trading comes in. I can't be held by a single price because it's just too difficult for me. The only price I'm always held by is my stop. So if I have the ability to get in around my areas of execution, because this is not a perfect business, the micros allow you to do that. I mean, and to me, I think that even for traders that have bigger accounts that can afford to trade the E-mini, it's still beneficial to start with the micros because you allow yourself that flexibility and you're not super price sensitive and you become a better executor of your strategy.
Yeah, absolutely. I mean, trying to be perfect with price that's just a tough game. And trying to trade a one lot is a very, very hard game. I mean, I'm with you. I'm also a scaler. I look to scale out in a way that covers my risks so that I can just relax and let the thing, work itself out. And if it happens to come back and stop me out on the balance, I don't have any risk on the trade left unless something dramatically wrong happens, which is possible. But in general, I want to secure my risk and let the runners run. So for me to get like a 2R or 3R on a trade, that runner has to go 5 or 6R. But it's okay for it to do that because I have to average my scale outs, my exits. It's okay for it to do that because I have no risk on the trade. In fact, I can just minimize my platform and go do something else while the trade is working until I hear the execution. I don't have to be so active with a one lot like you would have to do with the minis on a small account. You're binary. It's
Totally.
do or die. You know,
You rather have one chance at price or 10 chances.
Yeah, exactly.
I mean, look at it that simple. You know, what micros, you have the ability to do 10 to the 1 E-mini. Now, mind you, eventually you get to the point where you can go back to the E-mini, but you develop that skill by having the flexibility of not being held by a single price.
Right. So the next thing on the how-tos of sustainable trading is, and I've seen this many times, people trade and then if they make money, they start to incorporate other ideas into their trading. If they're not making money or they made money and no longer are, they switch, right? I used to use volume profiling. Now I'm going to do fibs. And what you're doing what we're doing when we do that as traders is we're starting the practice cycle over and over. It's like golfing as a right-hander, and that, you play a few rounds and it goes bad, and you just decide to switch to left-handed golf clubs. You're going to have to get the muscle memory and go through that process again. Don't do that. The best way to push your edge is not to extend your targets or widen your stop. None of that. The best way to push your edge is to gain enough in your account or have enough in your account to add another contract. That's how you do it. So instead of trading 2 lots, you go to 3, earn additional margin for that 3rd lot, for the 4th lot. Then once you have it, because you're doing well, add a 4th lot. Once you've gained enough margin, which every $1,200, you earn the right to add another ES contract or another NASDAQ contract. Don't get ahead of yourself. Don't try to trade that same 2 lot, but instead of going for 30 ticks, now you're going for 60 ticks because you want to get paid. That's not how it works. So our goal is to use the same swing, but change the club, right? We want to hit farther, change the club, use the same swing. That's the goal. And you do that in trading by adding more contracts if you are seeing a return on your effort. So it's really important not to be very, very critical about adding someone else's ideas to your trading. It is bound to throw things off for a while, okay? As good as it looks, you have to be very critical of the fact that you're about to change the way you trade. You're about to relearn trading. Stop doing that. Pick something, master it, do it long enough, process like bullet point 7 until you become the foremost expert at it. And then when you're the foremost expert and you're seeing returns, lever up, add more contracts, and have the capital to compensate for that additional leverage. Okay?
I think it's important. I think it's important to have a favorite setup too, because like for me, I have different tiers of setups, and a lot of people will say, well, how do you know when to trade bigger? Is it just because you're making money? Yeah, that definitely adds to it. If I'm doing well, I try to keep pressing, but I also have a favorite setup that I like that allows me to trade a little bit more aggressively or more when that setup comes. Some people may not have any sort of difference between any of the setups. I personally do, because I look at a specific setup that to me is like, that's just a potential all in for me. That goes back to kind of what I said earlier. I use leverage so rarely because that is such a rare setup. But when it does come, I am there. So I think in the process of growing and getting better, and growing your account, I think it's also important to know not just by when you're making money, but by what setup then triggers you to do it. This way, it's just more of a cleaner, more confident way about doing it. That's just my 2 cents on that.
Yeah, I absolutely agree with that. That's experience speaking right there.
Real quick, Morad, before I don't know how many more of these you got. We've got a bunch of questions. We've got just over 10 minutes left. So I wanted to let you know to leave some time for some of these questions that are specifically for you in this discussion.
Okay, so we're wrapping up here. The 10th bullet point is keep good records. I go through a rough patch at least once or twice a year. Been doing this for 22 years. There's a point where the market changes enough for me to be completely out of tune on every trade. And the thing that gets me back is a record of what I have done and how things are getting skewed. So I download my trade log. I use Edge Pro X as the execution platform. I go in there, I download all my trades, throw them into a spreadsheet. Soon we'll have a piece of software that does that for you. And I can then, these records help me troubleshoot. There isn't a professional sport or a professional out there that doesn't religiously keep journals or keep records or have someone who's keeping records. Think of baseball or basketball. They know the free throw shot percentage for every single player all the time. There's a reason for that. Keeping good records helps you move back towards being in alignment, and it stops you from going on tilt, because when you keep good records, you start to see that, that 12 tick stop that you're supposed to have that you decided to expand or delete, and now it became a 120 tick stop. That has a huge impact on your trade log, and it has a huge impact on your psychology. Keeping records stops us from lying to ourselves, and traders are incredible liars in their own heads. Like, we can explain away anything. The last thing I had for you here is, and it gets its own slide, is manage losses. If you're not in the business as a trader, if it's not your first priority, you're not in the business of managing losses, you're simply gambling. And if that's remember bullet point number 1, what commitment level are you at? If that's what you're committing to, fine. But if you're not managing losses and you don't have some sort of backstop, at EdgeClear we push auto liquidation, set platform level auto liquidation at the broker level. Any one of these brokers will set you up with an auto liquidation limit that gets you flat, locks the account, and you're done. You have to protect yourself from yourself. It's much like wearing your seatbelt. You don't think you need it until you really, really need it. And when it's not there, it's very, very damaging. So if you're not focused on risk and laying off risk and managing risk as a trader, first and foremost, you're probably not going to be here long enough, and you're going to be in that statistic of traders who could not make it. That's all I had to cover today for this topic.
Great stuff, Morad. I've got a bunch of questions for you. We're going to go right to them as we've got about 7 minutes left. First question, I will read all these questions to you. So the first question is, what triggers you into a position? Example, trading a ledge on the profile. Which do you find for yourself more optimum for the pullback of the break and retest point entry? Or wait to see if the ledge provides support and use the breakout as a continuation play using a buy stop, an example?
Yes. I mean, it's a function of how you see the information on the screen. Just because I don't like to talk about theory, I'd like to talk about practical things. This is my active trading screen. This is a 1 tick by 8 point and figure chart. There's some lines on here. There's some shaded areas. This is my price map. These are called stock zones. They're proprietary levels for Convergent Trading members. And in here, the platform puts in these calculated levels, RTH VWAP, full session VWAP, and so on. One of the setups I actually did a show about with Deli back in the day, that must have been 3-4 years ago, is a mid setup. And a mid setup, all that is the market moves away from this blue line, this dark blue line. This is the mid. And the first test back to the mid is a setup. And what I'm looking for here, what triggers that mid setup? I'm looking for what I call a zipper or consolidation that looks like this, and I'm looking for the break. And a lot of times, not always, the break comes back to the origin. You see this blue set of X's here? Blue set of X's. So it consolidated against my reference. I'm looking to get short, consolidated against my reference. If I don't catch it on the way down by hitting the bid and getting in, I'm offered at this area at the last bar, and I'm looking for it to lift my offer to continue. That's just one setup. And I have setups for breakout or momentum type, because the market's only existing in two conditions, in a momentum type condition called imbalance and balance. And so I have setups for either one of those. So your question, I say yes because it just depends on what the setup is, but this is just a simple example of an actual setup that I use.
Greg is asking, do you have a resource that goes over how to calculate average volume for a specific time of day?
Yeah, I actually do it through a chart. I have a chart that says that's called relative volume, and what it does is it shows me on any time frame. So if I want to see what the volume should be, has been on average, like this black line is a 20-day mean for this particular time slot. Like today, 8:30 Chicago time, this bar, right here, this red bar, the black tells me how many contracts have traded on a 20-day average for that particular time slot, and what it should be. So for the first 15 minutes, I expect 80,000 contracts to trade. The orange bar, the actual bar, tells me what it is. So today we traded 63,000 in the first 15 minutes out of 80,000. I know volume's light. And I know because we opened in yesterday's range and we opened kind of sideways, I know today's going to be choppy. So that's a very early indication to me that there's chop ahead, and to be cautious about it, about the fact that and I can do this for any time frame. Like I can calculate the time till now and create a bar that tells me where we should have been or where we've been over the last 20 days on average versus where we are right now.
What are the main statistics do you guys always keep on top of in the markets you trade to help time or to help frame trades or maximize your edge?
I can only refer you to my other company called Convergent Trading, where we produce a market statistics report on 15 different products. The key statistics are like how often do we fill a gap when we open in a gap? How often is the IB taken, or the first hour high or low taken? How often do we take out the overnight high or low during the day session? How often do we touch the prior day's point of control? How often do we, if we're inside of the value, how often do we tag the other side? How often do we have a neutral day? There are a lot of stats that we keep track of because this is a statistics-based game.
So for me, I don't use any statistics. I gauge sentiment a lot. So I actually will look at sentiment. Some tools for that. I will look at how much is being talked about from all of the macro people and a lot of the top people on Twitter. I look at a lot of conversations to gauge that. That's probably the number one thing I use Twitter for. And then I just use some basic indicators such as moving averages, Bollinger Bands, and I use anchored and auto VWAPs to tell me basic direction of it. And so for me, I don't know that statistics would help me or change anything that I'm doing. That's what I use.
You're trading a higher time frame than I am. It's
Yes.
different for you. Like if I was trading on let's say I'm an investor, I would be not doing any statistics at all.
Yeah.
If I'm trading off of a daily chart, I'm not going to do any statistics. So I want to make sure that you understand, the audience understands that we're not contradicting each other. It's just that we're on different time frames.
Yeah, exactly. I used to be super short term, and now I am definitely more of, I would say the shortest time frame I hold a trade would be several hours. I mean, I don't get into a trade. I mean, of course, price will get me out, but I am hoping to hold that trade for multiple days is my goal. I've been trading crude oil lately, not successfully, but not been able to hold those much into the overnight session. That's another story. So we're going to go to Coder, Dan Evans. He said, isn't it more likely to hit your stops all the time than ever hit your further target? That's pretty, it's, I mean, I wouldn't know how to even quantify that for myself, to be honest with you.
Is it more likely that you'd hit your stops all the time than your further target? Well, I'm trading, I'm going to try to keep this short because we're out of time, but I'm trading areas that have an advantage. If I'm trading without being able to answer the question of what is the idea behind the trade and why should the market pay you for that idea, then that trade is likely to get its stop triggered. So to me, the most likely scenario where I get stopped out is right at the beginning. That's the highest risk. My percent full stop is relatively low, 35, 33% historically, something like that. Past performance, not indicative of future results. But as soon as I get risk covered, I don't really care. It's not up to me. I don't really care. So if my risk is covered and then I get an additional scale out and it turns around and it stops me out, what that's saying is the market is not really supportive of that idea. My bias or my sentiment read, like Deli was saying, isn't correct. But in general, once it runs, it runs. All I care about is covering risk and letting the rest of it just flow. I only need 1 or 2 trades a day to run all the way. I don't need every trade to run all the way. That's not my objective.
One thing I will say on my time frame is that once I get a trade to go my way and I get to take some off, I'm never letting it go all the way to its original stop. So I agree with Morad on the aspect that if I'm going to get stopped out, it's going to happen relatively early in my trade, especially on a full position.
Which
if
is
I'm
what we want.
Yeah, right, exactly. And then if a trade starts to go my way, then I become, I don't want to say more of a micromanager with it, but I am definitely someone that, especially in these markets, because they come back with such, I'm trading crude oil and NASDAQ right now. It's like I keep really tight leashes on them, and it's making me get out right away. Because if I don't do that, and the couple times that I have not, I've tried to let stuff go. Yeah, they come all the way back, and then I'm still getting out before my stop because to me the dynamic has changed. In the trade. I know we're out of time, Morad, but a lot of people waited a long time for these questions. I think you and I just give them real quick answers.
Show.
Yeah. So this is the one thing that this is a super easy question. He asked a couple of times. He's like, auction, market, and volume profile resources, convergent trading.
Yeah, I would have to refer you to something that I know about, which I created, which is convergent trading. It's not the end all be all. Auction market is just a way of looking at how or why price ticks. Volume profiling is a way of organizing information to see where the market liked price versus disliked price. The best resource I can offer you is convergent trading. You can find it at convergenttrading.com.
How does a beat up trader make a return? I'm going to tell you, I've been beat up many, many times. Still happens to me in my career. You make a return by taking time away and coming back small. And to me, that's the only way I've ever been able to come back, is just to kind of forget what's happened to me, continue to remain a positive attitude, stay positive, and come back really small. And, try to just put some winners up on the board and getting your confidence back. Because, if you're beat up, that means your confidence is beat up. And I've been there. It's time away and come back small. That's the way I look at it.
It also means that you've deviated from the plan and you don't have a plan. So I would throw you back to these bullet points and have you walk through them. If you're a trader that's working for me that hit a 3-day losing streak, so you're out for the week, then you come in the next week and hit a 3-day losing streak, you're done until you can prove to me that you have a plan and your plan works. Otherwise, I'm not going to put up more money for you to trade. You should treat yourself the same way. It just means that you are not following your edge or don't have one. So go back to the drawing board. And by the way, please be forgiving to yourself. This is a tough, unforgiving job. All other jobs, we can hide behind other people, hide behind other people's performance. This one, you cannot. So be kind to yourself. You can do it, in my opinion, but you have to treat this professionally. This is not, futures are not for Wall Street bet type stuff. This is serious stuff, okay?
Look at, man, I'm on the bench right now. I'm taking the next couple of days off. I had a great run in Crudele, just gave a huge chunk of it back, jarred me myself as well. And I look at it and say, I stayed on it. I did what I wanted to do. You know, I made a tweet the other day where I talked about I got out of rhythm one time because I had a really good winner on and I pressed it into a rally and it just came off so fast that I ended up getting into a full position that I had to just burn out of right away. And I ruined a good trade. And kind of from there, it just, you know, was jagged for me. So I put myself on the bench, you know, got to step back to get clear again. Like, and Morad said it perfectly. You got to be kind to yourself, man. We all make mistakes. It's tough. And he and I will tell you, no matter how long we've been doing this, like I said, I'm on the bench the rest of this week. So that tells you where I'm at.
Good for you. At least you're doing it.
Yeah, man. And believe me. So, guys, a lot of these questions we answered within the interview today. I can't tell you how much I appreciate all of you guys participating in this. We really do thank you guys so much for signing up for these free giveaways. And I'm excited about what we're doing going forward, Morad. I think this is great. Thank you so much for the material you put out. I've said this for many years in the show. I'm not sure anyone does more for the community than Morad. Definitely check out EdgeClear. Definitely check out Convergent Trading. And there's people behind the scenes that really help you. It's not like just an email or something. There's people that call you. They're great teams on both sides of the fence. And thank you again for this partnership and coming on the show today.
Thanks for having me, and thanks everyone for listening in. Hopefully you gained something today that might have an impact on your trading tomorrow and the days going forward.
That does it for this week's show, everybody. See you next time. Cheers.
Cheers.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.